Hello and welcome to the Hub International webinar, Busting D&O Liability Myths, What Private Company Leadership Needs to Know. My name is Adrian Ottolano. I'm Executive Vice President with Hub's Executive Liability Practice.
Hi, I'm Larry Conrath. I'm the Management Liability Practice Leader in the Central and North regions for Hub.
So before we hit on the agenda, let's look at the poll question we asked all of you to complete, and thank you very much for taking the time to do this. We asked you a question: what do you find most confusing about D&O insurance and the purchase of D&O insurance? And the results weren't surprising based on the discussions Larry and I have on a daily basis. So just over 34% of you said, what exposures does D&O cover? Great. Over 31% of you want to know how it works with other management liability coverages. A couple of examples: employment practices liability, cyber data security, maybe even your general liability. Just over 11% want to know who in the organization D&O protects and covers. Just over 11% why my general business policy isn't enough. Why do I need to buy the D&O product? And we have a split of 5.7%, why my private company needs it, and none of the above. So thank you again for your input there, and we're going to hit on all those areas. I will say that this also is a webinar that reaches organizations across North America, and so I do know that we have some companies from Canada calling in. We're going to hit on D&O insurance topics that are universal to all organizations in the U.S. and Canada, but there are some nuances, particularly in the area of regulatory oversight. So please go ahead and connect with your Hub Canadian broker for further dialogue on that regulatory piece. So the agenda: during this webinar, we're going to share some insights into D&O insurance, debunk some myths about what it does and doesn't cover, and provide some guidance for finding the right policy for your business and its leadership. We encourage you to download the Broker Insight Report from the resource toolbox at the bottom of your screen. That report will provide more detail than we can go into that during the webinar. So the risk is real. Most businesses would never consider operating without insurance to protect their assets from fire, flood, or other accidents. But far too many, unfortunately, overlook D&O insurance. We believe it's essential for your organization. And what we're looking at here are some results from the Chubb 2016 Private Risk Survey. So Chubb had some organizations actually complete this survey. It's powerful. 1 in 4 private companies has experienced a D&O loss in the past 3 years. Damages resulting from those D&O claims average a whopping $387,000. And you can see here that they can reach as high as $17 million. So the risk is real. I would add that, this is a survey, so keep in mind that many directors and officers' liability claims are unreported. Settlements are confidential. And when you really think about it, organizations that go into bankruptcy, liquidation, they typically don't complete surveys. So I would argue that it's higher than 1 in 4 companies. And I think part of the other issue is many organizations that currently purchase directors and officers liability don't know how to identify a claim. So what I'm getting at is many claims go unreported. So we're going to try to remedy that today. I'm going to hand it to Larry, who's going to take us through the first poll question. Larry?
Thanks, Adrian. So everybody, if you didn't know, this is going to be an interactive webinar, and this is the first of a couple questions we're going to ask you to respond to. And this one, we're going to ask, based on your knowledge and experience, which of the following is the most likely source of a D&O claim against your business? So option A is shareholder lawsuit, so the owners of your company, whether that be the unit holders of an LLC, limited partners in a partnership. Option B, regulatory litigation. C, competitor litigation. D, employee lawsuits, so think harassment, discrimination type claims from your employees. customer lawsuits, E, and then finally vendor lawsuits, anybody who provides goods or services to your business. We'll give a couple seconds here to let everybody respond.
And Larry, I think as we're waiting for folks to complete the survey here and respond, when you break down this question, organizations, whether you're privately held or a nonprofit organization, you're having this dialogue internally anyway, whether you're the CEO, the CFO, or any part of the leadership team, right? So you're talking about these stakeholders, these external parties within your internal and external ecosystem. And now the question is, okay, who can file suit against you?
Okay, let's move on and take a look at the results. All right. So most popular answer here is employee lawsuits. Interesting. 49% of you said employee lawsuits. And the quick answer here on that is that probably of these answers, employee lawsuits, while we would consider them to be a very significant source of exposure, are really not something that's necessarily addressed by D&O insurance, and something we more do another product for called employment practices or EPL insurance. And oftentimes that is packaged with D&O insurance. And again, don't get me wrong; these are exposures which I can see. You're going to have D's and O's named personally, so something you should be aware of. But this is part of our job as brokers to make you aware of how your various management liability coverages, D&O, which is just one small part, all fit together. So employee lawsuits, probably not the most significant of what we call quote-unquote D&O claims. We'll describe a little bit more about what the D&O is intended to cover here. But again, interesting. And then option A, shareholder lawsuits. And I think that's not a surprise from our side at all, because obviously a lot of you, we think about D&O, we think about large public companies and class actions from investors. So we're at 35% there. We have some answers for regulatory litigation, 18%, competitor litigation, 13%, customer lawsuits at 22%, and vendor lawsuits. So again, all of these answers are correct. And again, employee lawsuits maybe being a little bit of an exception because there's another product intended to address that. But interesting results. Well, let's actually move on and take a look at another result from that Chubb survey that Adrian referenced earlier. Chubb had asked all the private companies that completed the survey if they'd ever been sued by these 5 groups. And the number one source of D&O litigation here is customers, with 54% of clients having been sued by a customer. Now, taking a quick step back here, when we think about D&O lawsuits, I think an important clarification is, you think one of the questions earlier on is one of the sources of confusion in the initial survey was, why does my general liability policy not address D&O claims? And when we think about D&O, we need to really be thinking about financial damages. So your general liability is intended to address issues primarily related to bodily injury or property damage. It's not going to address a lot of the sources of claims we're going to speak about here today. So when we talk about customers, again, we would look at claims. You might say, well, I also buy another coverage, professional liability coverage, or E&O insurance, as it's often called, errors and omissions. Shouldn't my customer claims be addressed by that? And the answer is yes, most are, but however, a lot of that has to do with your failure to render professional services, and if you messed up something in the rendering of those professional services, or at least your customer alleged that you didn't provide services to their standard, that's where professional liability steps in. However, oftentimes those customers, you also have other sources of types of claims from customers for things like unfair trade or deceptive trade practices that could also be alleged against you. And those are things that really we need to focus on D&O being a potential source of coverage. The next example is vendors or suppliers, and we actually have a case study on this a little bit later. But an example of a vendor or supplier claim could be somebody alleging some sort of unfair dealing, how you awarded a contract, for example. And at 27%, the next one down here, maybe one of the most scary of the sources of claims is that the government or regulator. Why do I say scary? Because we are dealing with regulators. We're talking about whether it be federal, state, local, municipal entities with really a vast, almost unlimited resources and ability to really drive a lot of demands from you, whether, asking you to come in for interviews, depositions, provide discovery of your email or other documents. And these are very expensive investigations. And everybody here on the call today is likely subject to some sort of regulatory oversight, whether it be from, we think about the big names from the federal government level, the EPA, the FDA, the FTC. We've got the Consumer Financial Protection Bureau. But then we have self-regulatory organizations as well that, if you're part of a specific profession, you may be subject to oversight by another organization. So regulators are a big source of claims and an expensive source of claims. The defense costs that can be racked up, and these things can go on for quite a while, can be very significant. Another example here, we talk about regulators. When we talk about the government can also be a supplier, can also be one of your customers. And think about exposure there from the False Claims Act. I saw a statistic last year that $5 billion had been collected under the False Claims Act in 2016 by various governmental entities. And I think defense contractors, healthcare organizations who build Medicare are very aware of the significance of those types of allegations as well. And again, very expensive to defend yourself, even if you've done nothing wrong. And then I'm going to move down to the competitor. Competitor claims are very common with D&O. We think of examples of issues like tortious interference or antitrust. And then at the bottom of this list is partners or shareholders. So that shareholder claim exposure, it's out there. Don't get me wrong. Obviously, we see almost 1 in 4 companies have experienced a shareholder claim, but it's not the number one source of claims. And when you think about private company claims, you need to kind of remember everything else that goes into this, even if you're a sole proprietorship. So I think that's important to get on and move in to bust our first big myth. D&O is only for public companies. I don't have D&O risk because I don't have shareholders. And this is a common myth. In that survey, again, we saw that 1 in 3 private companies believe they don't need D&O coverage because they're private. And obviously, this myth is busted. We've walked through a number of examples here today where you're going to see there's significant sources of exposure, and you do have D&O liability as a private company. And a lot of this liability can be insured by way of a private company or nonprofit D&O policy. I'm going to move on, and Adrian's going to move on to myth number 2.
Thank you, Larry. All right, myth 2. Family-run businesses don't need D&O. Nobody in my family is going to file a D&O claim against the company or any individual. I'll add to that quote. So 30% of organizations, family-owned businesses, believe D&O coverage is unnecessary because their business is indeed family-run. Well, we're busting the myth. So let's start with 2 reasons why this myth is busted. Number 1, when you look at business continuity and legacy issues, particularly if we focus on, you've got first-generation family members starting and building the company. Then you look at second and third generation. Those second and third generation family members may be on the management team. They may be on the board. Let's focus on the board for a sec. So you have second or third generation on the board. They're looking at the organization. They may want the cash flow, the personal cash flow from the profits of the organization. They may want to sell the organization, but the management team may have a different direction that they believe is best for the stakeholders of the company. Perhaps the management team wants to expand with additional personnel, bring on some key talent, make an acquisition, open up new locations. So now you have a situation where continuity issues are in play, non-family management, making key decisions. And when you think about directors and officers liability, yes, today we're talking a lot about protecting the balance sheet of the organization, but you're protecting personal assets for the people. And so Larry and I often say, in buying this product, you have to put that selfish hat on because ultimately, if you're a leader of an organization, especially in an officer position, making key decisions, you could be a target for D&O claims. You want the contract to respond. So let's move on. D&O risks increase over time. So we're going to go through some examples. And really what we want to achieve today is bring you over the wall. We want you to see how an underwriter views your organization, views your risk profile. If you're a Chubb underwriter, Travelers, there are over 50 underwriters here in the U.S. offering this coverage. I would say the same in Canada. How do they underwrite, and what do they see as key events that would move the needle on pricing, deductibles, and even the limits of liability that they're going to offer you? So you could be a startup organization, or maybe once upon a time, and if you look at your organization's history, you had to raise capital. So there's prospectus liability there, right? There's an offering memorandum that you have to sign personally on the dotted line saying that you're going to do something with that capital in a good way and have some good results from that. So you're raising capital. It could be equity or debt. You're expanding the workforce. You make a small acquisition in your history, or maybe it's a large acquisition, but either way there's diligence and there's representations and warranties made by the seller, and you're taking capital from the company and infusing it into this new acquisition. Maybe you hit a tough patch, a rough patch, and you're downsizing. Maybe you overexpanded. Now you have to have a RIF, a layoff reduction in force. All these items we're going through right now equate to risk from the lens of the underwriter. You lose a major customer in your history. You experience a hostile takeover or acquisition from another organization that you're fighting. You lose a key executive, and we're all dealing with increased regulatory oversight if you look at the trend over the past few years. So all of these things, you can throw them into a soup, if you will, of exposure. And the point we want to drive home here with this illustration is that your directors and officers liability policy provides you value with every day that passes within your organization's history. Because the directors and officers liability policy you're about to put in place for the first time, or maybe you're working currently on your renewal, that policy, if written correctly, if negotiated correctly by your broker consultant, is going to provide coverage for alleged wrongful acts against you dating all the way back to day one of your organization. And so if you've been around several years, there's a lot of history. Just think about all those decisions and indecisions you and the management team have made. And that policy is going to increase in its value. And also, food for thought is, in knowing this now, do you want to move carriers? Does it make sense? You know, what's it going to take? What does loyalty look like and partnership look like between you and your insurance company? So we're going to move through a series of case studies today. And I'm going to start with a technology startup case study. So here's the context of the case study. A technology startup based up in Northern California was on a hiring spree. In that region, you have a very limited talent pool. So it hired many of its employees away from a nearby competitor. The issue is the competitor sued alleging unfair competition, theft of intellectual property and trade secrets, and patent infringement. The suit ended up targeting the organization along with a number of employees who had been hired away from the competitor. So here's the outcome. The D&O policy was triggered because the individuals were named and targeted. The insurance company paid out more than $500,000 in defense and indemnity. So the takeaway, D&O is essential because it can potentially cover competitor lawsuits you might never see coming, for example, claims for poaching employees. We're going to move to the personal side of D&O protection, but before we do, let's hit on another poll question. So please join me in answering this poll question. Which of the following are protected by D&O insurance? A, the organization's assets, B, board members, C, officers, D, employees, or E, shareholders. So we'll give you a few seconds here to complete the poll question. I will say while we're waiting that you know, the dialogue you have internally as a management team is important. Why do you buy this coverage? You know, what what are you trying to achieve? What's your buying philosophy? Are you looking to protect individuals, the company? What types of claims are you looking to protect parties from? What's going on in your day-to-day business as you talk through your goals and objectives for 2017 going into 2018? And what are some of the traps you could fall into? What are some of the barriers? Who are some of the parties that that may file a claim against you? Okay. So let's see what the poll results show us. Okay. Very good. So as you can see from the poll results, a majority of you say officers. That's appropriate. A close second, board members. I'd like to see that we have the organization here and employees. Outstanding. 29.1% of you said shareholders. So the correct answer with the poll question is that you will not find shareholders covered under a directors and officers liability policy. And I'll just hit on a couple reasons as to why. Number one, if you're the management team, the board, the officers, even employees, because you are covered under a private D&O, nonprofit D&O policy, you're concerned with shareholder litigation, claims coming against you or the organization. So by adding the shareholder to the policy, you have an issue we always refer to as an insured versus insured issue. These policies won't pay for infighting. And so you want to make sure shareholders are not covered under the D&O policy. That's point number one. Point number two is the directors and officers liability underwriting community won't allow it typically. Now there are on some occasion one-off scenarios, but typically it's not allowed, and the reason expressed by the underwriters is what we just outlined here, that you're trying to protect yourself from shareholder litigation. Okay. Larry, I'm going to hand it back to you if you could take us through myth number 3.
Thanks, Adrian. So myth number 3, D&O only protects the board, the directors, and the officers. Many people believe that it only protects these specific individuals and won't cover any employees if they're named in a D&O claim, and that's busted. That's incorrect. But the reality is that there's a lot of flexibility. Just taking a step back here, there's a lot of ability to tailor your D&O coverage. And the reason that there's not just an off-the-shelf product is because we really want to make sure that the policy fits your business needs, your priorities in terms of who is covered, when the coverage responds. And taking an off-the-shelf policy is not going to accomplish that for you. But you can insure a number of these individuals. It's possible to insure your employees. It's possible to insure your independent contractors on the D&O. That's a conversation you need to have with your broker. So when you look at what are we doing, what are we trying to accomplish? We want to ensure the full picture. When you break down D&O, you really look at two distinct pieces. And when we look at one side of it, we have personal asset protection for the Ds and Os, and the other side we have corporate asset protection or balance sheet protection. Now the reality is that most D&O risk falls on that balance sheet side protection. As a company, the directors and officers under your bylaws likely have pretty strong indemnification provisions where the company is obligated to defend, indemnify you for most types of losses as you would encounter in your role in the company. The same thing likely applies to employees. And you may decide to engage with certain independent contractors who work with you, and if you're providing any type of hold harmless agreement to them for their actions as well, you may have an obligation to them. So as a company, you have a lot of liability just from your obligation to defend individuals who are named in a claim. Now, in addition to that, on the balance sheet protection side, the company itself is an insured. It's called private company D&O has a unique feature called entity coverage that is not found on the public D&O side, which protects the company itself if named in a number of types of claims. And that has nothing to do with necessarily a D&O being named at all. This coverage can be tailored. You can buy the coverage and you have to decide your policy limits, how do you want them to apply? Who gets to have those limits first? Who has priority in a claim? So, we talk the balance sheet protection side is important, and for a very closely held company, the balance sheet side protection may not be very different than the personal asset protection because that a lot of your wealth as a business owner may be in your company. Now, that said, personal asset protection is probably the purest essence of the D&O coverage, and I would say for most individuals here on this call, it's going to be the most important. We talk about an era today of increased regulatory presence and an era of seeking personal responsibility, personal accountability. I think many of you may have seen the what's called the Yates Memorandum from the Department of Justice, the Deputy Attorney General issued in 2015 that talked about, the government looking to pursue more personal accountability rather than just going after companies for these investigations. And we saw this, throughout the banking crisis. There wasn't, some individuals were personally accountable, some weren't. But at the end of the day, personal asset protection is probably the most important part for most folks, and the D&O policy is going to be the most critical piece of that, because that's the part that's going to respond when there's no company left, there's no assets left to be able to protect you, to be able to defend yourself. It's a backstop, it's a safety net to make sure that your personal assets, your 401k, your child's college savings accounts aren't at risk. So, sorry here, jumping ahead. I want to move on and talk a little bit further about that. The next couple of case studies are actually going to talk a little bit more about that personal asset liability, and not surprisingly, these next two case studies involve companies that went bankrupt, that were insolvent. So there was no company balance sheet available there to protect them. So case study 2 speaks about to a client we had that was an electronics recycling company. It's interesting, and it kind of shows what happens after a company goes under. This particular company had aggressive growth, was doing very well, but also became highly leveraged and maybe got a little over their skis, and some operational issues became a bump in the road, and unfortunately led to a spiral. And next thing we know, this company was foreclosed upon by their bank and put into liquidation. Now, at the same time, this all happened rather quickly. We have a company that was there and there one day and not there the next. A significant stockpile of these disposed hard drives, which had some potential hazardous materials in them, were left in a storage facility. And the local state environmental agency wanted to pursue action, but there's no company to go after. So what did they do? They're going to look for the deep pocket. There is no pocket on the company anymore, and they went directly after the former CEO for personal liability. In this particular situation, it was very fortunate we were able to negotiate favorable language to their D&O policy so that it did respond. D&O generally won't cover a pollution-related issue, but we did have favorable exceptions to the pollution exclusion, such that this individual was able to defend themselves to the tune of over $100,000. I don't believe that's resolved yet, and damages in this case were exceeding 7 figures alleged. So definitely the D&O policy became a lifesaver in that particular situation. I want to move on to and the takeaway here, if you're a director or officer or a key employee even, your liability doesn't necessarily end when you leave the company, and obviously when the company ceases to exist. So you have to make sure that we're negotiating these policies with a long-term view, making sure that we're getting appropriate coverage, because that coverage is it's going to be much harder to get that coverage when you need it, unfortunately. So make sure that you're partnering with the D&O insurer for a long-term relationship, getting the appropriate coverage up front so that you're prepared in the event of the worst-case situation. So case study 3 is a similar situation, but maybe not, not maybe, a much worse result, unfortunately. This next case study speaks to a Las Vegas developer, a real estate client that we worked with that was hit hard in the 2008-2009 recession, much like much companies in the real estate and the rest of the world were. And unfortunately found themselves in a bankruptcy situation. So this company actually purchased at one time $20 million in D&O coverage. But over time, and as the economy got tighter and cash flow became imperative, they slowly reduced their D&O limits, and at the time they entered bankruptcy, only had $1 million limit. We obviously advised them to try to keep those limits higher, but again, at that point, it was a survival situation, and so we were happy that they at least had the $1 million in coverage. As they went into bankruptcy 11 months later, unfortunately, the bankruptcy trustee filed suit against the former management team, a number of the former managers over a number of years. We had 8 individuals that were named, and the breach of fiduciary duty, wasting of corporate assets were some of the allegations. And unfortunately, each of these individuals, everybody's kind of looking out for themselves in these situations, and everybody retained their own separate counsel, and that isn't a surprise. If you haven't been through it, that's great. Hope you never are, but obviously those defense bills mount quickly. In a short period of time, those 8 counsels racked up $500,000 in defense bills. And the initial demand from the trustee at mediation was $12 million. Negotiated further down, but after the $500,000 was expended, the insurer in this case had to cut a check to the remaining 8 individuals, split 8 different ways to basically defend themselves for the duration of the case and be able to settle it. So very, very challenging position as a D&O broker. It really is, a terrible situation for us to watch. We try to, we hate to see anybody left uninsured, and unfortunately that's the case here. And so to take away, even in Vegas, some gambles aren't worth the risk. I mean, they tried to save a little money on the D&O insurance in the short term, but it ended up costing the company significantly, and really more specifically the individuals. So especially in the case of bankruptcy, you can lose many of those corporate protections and indemnification that you count on to safeguard your personal assets. I'm going to hand this off at this point to Adrian for case study 4.
Yeah, thanks, Larry. Before I hit on case study 4, that case study you just ran us through, that was a tough read. You've got an unfortunate situation where you're from 20 million limits in limits down to 1 million. To our earlier comments, this is why it's so important for the management team to get in alignment in terms of how they're going to buy this product and how much they're going to purchase. Because if you're part of that organization that went into bankruptcy, and you're named by the creditors in a suit, perhaps you left the company. Perhaps you're the former CFO or controller or any other part of the management team. You've been away from that organization for 2 years, as an example, and now you find that they only purchased $1 million in D&O, and it was much higher when you were making that product decision. So get in alignment with your team.
Adrian, related to that, sad part of it, it was a former CFO of the company, and there had been a couple who identified this at the time and actually paid for this personally, the policy, because he alone recognized the value of the policy he was going to provide. And I think he actually had a hard time getting paid back to from those D&Os, but for their portion of the premium. But I can tell you that the premium came to him pretty quickly once that claim was filed. Kind of funny, not funny, but again, you got to be sure that the executive team firmly understands the value that they're getting, or not getting by not buying the coverage.
Okay, thanks, Larry. So our final case study, supply and demand for damages. Let's take a look. Here's the context. Expecting a significant increase in business, a retailer, our insured, advised one of its suppliers to build up their inventory. Business did increase for the retailer, but it decided to use a different supplier. The issue? Clearly, the original supplier sued the retailer, alleging that they suffered damages as a result of relying on the retailer's promises of more business. So the supplier was left with that inventory. Outcome, the retailer's D&O coverage responded, and the matter was settled for $500,000. So the takeaway, D&O risks exist in practically every business relationship, and every decision you make that affects those relationships can put you and your business at risk and end up costing you a lot of money. Think of the D&O policy as responding and protecting you and your team and your organization, even when the allegations, whether they have merit or not, they could be frivolous allegations. You're talking about defense costs to get to that motion to dismiss, to close out that claim or lawsuit quickly, and also indemnity. So all the day-to-day interaction that you have as leaders within your organization, as we said earlier, decisions and indecisions, give more value. The D&O policy will provide you more value. Now, Larry and I are going to get into the weeds a little bit, and when we transition here to the topic of when does a D&O policy respond, we want to make sure that we're providing you some education, some questions, some things to look at at your next directors and officers liability renewal or your first time purchase. So D&O coverage will respond to protect the organization, as we stated, and the personal assets of leadership when you encounter claims. But let's talk about 3 areas that are important to really hit on with your broker consultant. And the first 2 are within the same vein. Let's start with the fact that a D&O policy is what we refer to in the insurance world as an all-risk policy. First, it is a named perils policy. I'll give a quick example of a named perils policy that many of you already purchased. Your property policy is a good example of a policy that is very clear and concise and will outline and identify, list out the types of events or claims that it's willing to cover on your behalf. We will cover you for flood. We will cover you for fire. So D&O coverage is broader in wording, which is a good thing. It's a bit more vague. In the all-risk world, the way a good, competitive, well-negotiated policy will read is that a D&O policy is going to protect the past, present, and future directors, officers, employees, if named in their capacity as such for alleged wrongful acts. So if somebody comes with a claim, which a lawsuit is included, we'll get into what a claim is a little later here, but if allegations are made against you in your capacity of being a board member, an officer, an employee, that D&O policy should have language that will allow it to trigger. Add in the fact that we want a wrongful act trigger that's very broad, and your broker consultant can run you through how that language should read. And when you consider these 2 things, many of you are thinking, well, what does a D&O policy not cover? And really that's where we'll get into later in the discussion about exclusions and how the underwriting community will carve out coverage value and take back how the contract reads and take back coverage. So you have to pay close attention to the exclusions. The final area we want to hit on here is, the policy is written in a way to where the definition of claim will include a monetary or non-monetary demand, and then you sprinkle in some allegations made against the insured parties. Again, insured parties are the people and the organization. So if you believe a lawsuit meets the definition of claim, you're correct. But you have to be careful because these policies have a much broader definition of claim than you would think. Yes, lawsuits are included, but a written demand for monetary or non-monetary damages or relief is also part of the definition of claim within a competitive D&O policy. What does that mean to you? That means an email, it could be a handwritten note, a letter that you receive from an employee or any of the parties we've talked about, competitors, regulatory bodies, attorneys, outside shareholders. If you receive a written demand, you need to take a close look at it. Have your counsel look at it, your broker consultant. The policy requires you to get that reported in a timely manner within the policy period. And as I stated earlier, be very careful and review the list of exclusions found within the policy. In fact, that's a great segue into our next discussion point here. So not all D&O policies are created equal. We're going to cover 5 must-haves to include in your D&O policy. And I want to be very clear here. These aren't the only haves. These are must-haves. And I think what they do is they really start that beneficial, fruitful dialogue with your management team, but also your broker consultant when talking about this purchase. I would also recommend that you spend quality time to talk about this coverage. We find that a lot of organizations, whether they're constrained for time or not, but you're talking about a lot of insurance policies at your renewal typically, your workers' compensation, your property, your auto, your general liability, the package. Make sure adequate time is allocated to the directors and officers liability. The underwriters are at a point right now in this marketplace where they're asking more questions, and it's your broker's job to make sure that they can move that needle to benefit you on terms and conditions based on the information you can provide them. So make sure your D&O policy protects you for. We're going to run through a quick list of 1 through 5, and Larry and I are going to take turns here. But Larry, why don't you take us through item 1, lack of clearly defined reporting requirements?
Yeah, so again, going back to your point, Adrian, it's very important to understand your D&O policy and what you're buying. You're spending good money on it. We expect it to respond. And obviously, to the benefit you can read your policy, that's great. Have that discussion with your broker. But one of the most important areas of your policy to review is going to be what triggers a claim and what are your obligations when a claim is triggered, and how that process works. Because what we see in policies is oftentimes we can negotiate the best coverage, the narrowest exclusions, broadly worded definitions. Yet, if you don't report the claim, this is a very easy out for the insurer to be able to get out of coverage. These claims are claims-made policies. They require that you notify them prior to incurring any defense costs, obviously before you get engage in any negotiations or settlement discussions. So just understanding your policy can really help avoid this item 1. But I think as brokers, we do try to clearly define those reporting requirements, make them work and fit to your organization so that the appropriate individuals would trigger the knowledge of an organization to report a claim. But again, don't hold these things back at all. If you decide not to report a claim, you're obviously putting in jeopardy coverage for that claim, but also potentially future claims because of how claims-made policies work. And again, that's one of the most common sources of denials for D&O claims, but we really believe probably one of the most avoidable as well. Adrian's going to move on here to point number 2, and that's lack of antitrust or unfair trade coverage.
Thanks, Larry. So I'm going to try really hard not to get in the weeds on this one. In fact, Larry did a tremendous job of running through the value of antitrust coverage, and also he talked earlier in our discussion about regulatory oversight and antitrust-focused claims. But I think the driving point here, let me give you an example. Let's say you purchase $5 million of D&O insurance. Now, a competitive D&O contract, because we do see this as a legal buy that you're making, a competitive contract is going to state that the entity, the organization, does not have antitrust coverage. But the insured persons, the board, the officers, the employees, will not have that exclusion or that restriction under the policy. This gets back to my comments about an all-risk policy. So you could say that they do have antitrust coverage. That's a good thing. Depending on your sector, who your customers are, how competitive of a landscape your sector is that you play in, you may want antitrust coverage for the organization, and it's possible. You can secure that. I will tell you that you're going to pay an extra premium for it, but be cognizant of the fact that the insurance companies are most likely to provide the coverage for the insured persons and the organization at a lower limit of liability than the $5 million example I gave. So again, you buy the $5 million policy, the protection's there for the individuals. You go to the insurance company and say, you know what, I want to expand the antitrust protection for the organization. I'll pay extra for it. Now, it's likely that the insurance company, if they're willing to provide that protection for the organization, they're going to drop your $5 million limit for this exposure down to $1 or $2 million. And they may add a higher deductible, and they may also add what we call coinsurance to that claim if it were to come in against the organization or the people. Coinsurance is your skin in the game where you pay 10%, maybe 20% throughout the course of the claim. What we're getting at here under item 2 is that you've got to make the decision, make an informed decision, whether you're going to keep the coverage as is, providing higher limits of liability for the individuals, or expand it out to the organization and pull back that coverage down to a sublimit of $1 or $2 million in coverage. But we add it to this list because it's a good dialogue to have, particularly when you look at the new claims trends in our dialogue with carriers and the types of claims the leading carriers have been paying out over the past 6 to 8 months. A lot of antitrust claims coming in. Who knows if that's going to change course with the election and what's on the horizon, but that is the trend that the carriers are seeing now. So add that to your list.
Yeah, I mean, just following up to that, Adrian, I mean, antitrust, I think a lot of people get lost in the weeds on what that means. I mean, don't think that just because you're a smaller business that this exclusion doesn't apply. When we use the term, we're kind of speaking a little bit of D&O language here, but, that exclusion often goes into things like unfair trade or predatory pricing, things that, again, a lot of entity-based claims may actually have alleged against them. So take a close look at that exclusion when you're looking at your policy, and to Adrian's point, decide how you want to balance that coverage. That whole very philosophical discussion. Do we want to expand that balance sheet coverage because it can be a critical grant?
Yeah. Thanks, Larry. So next we have item 3, overly broad conduct exclusions for criminal acts and illegal profits. Larry, I'm going to let you take that one.
Yeah, so I don't think anybody on the phone here today, or hopefully not, is planning on committing any crimes or legally profiting or defrauding anybody. However, what you'll often see is that many of these types of claims, whether they be from a regulator or a competitor or whatnot, they may allege some sort of fraudulent activity against you. And obviously, the D&O policy is not going to ensure that, and so pretty much every D&O policy is going to have a conduct exclusion, we call it, for these types of criminal acts or fraud issues. However, it's important that that exclusion be tailored. Just because the claim actually alleges those activities took place doesn't mean that they did, and you want to be able to defend yourself. And to defend yourself can be in a very expensive process, a very lengthy process. So the exclusion needs to be worded in a way that you will ensure that, number one, that innocent individuals are defended throughout this process until the end, because obviously both good guys and bad guys can be named in these claims. And also that you have the opportunity to continue the defense till a final adjudication. And there's various versions of that language that we can work with the insurers, but you want to have that policy be able to extend and get you through, a couple rounds of appeals or whatnot, just because you have an adverse decision along the way. And it's a philosophical discussion too. At what point do you think it's fair that some individual may continue to use up your D&O policy proceeds? But if the exclusion is too broad, you're going to wipe out coverage when you most critically need it in a defense situation. So again, it's important that exclusion is tailored. And that's just one of many exclusions, obviously. Go ahead.
Oh, I'm sorry, Larry. Earlier in the discussion, you brought up a very, very good point about bylaws and indemnification agreements. And I would say to our audience, for this item, this coincides with your request or demand for indemnification from your company. In other words, if you're looking to serve on a board of an organization or an officer position or a high authority employee position, ask the company for a copy of the bylaws, and within the bylaws, you should find the section that talks about how the organization is going to indemnify you if you're named in a claim. And you want to make sure that indemnification language is as broad as what Larry's describing under the D&O policy. In fact, you want to make sure the two align with each other, the D&O policy and those indemnification commitments from the organization. So that's your first line of defense, is that balance sheet of the organization and making sure the organization's protecting you, advancing defense costs on your behalf, paying for your indemnification. The D&O policy should be seen as a safety net to that when the organization cannot pay, or a way to reimburse the organization in their commitment to you, the individual, if you're named in a claim.
Adrian, I think you're going to move on here with the next one. Going on, we talked about one specific exclusion, but there's a number of exclusions that you're going to cover here in terms of that should be looked at and tailored specifically by client.
Yeah, so the final two items, 4 and 5, pertain to exclusions. And before we get into detail on these, I'll say that there are exclusions that are found within all D&O policies that are universal. They're consistent. And those exclusions really point you, the buyer, to other insurance products you should be contemplating for purchase, or maybe you already purchased them. And I'll just give two quick examples of the types of exclusions you would see as standard within a director's and officer's liability policy. One would be if you're in the biotech pharmaceutical space, you'll find a bodily injury exclusion within a D&O policy. Well, you should be buying a products liability policy to protect the board, the officers, the employees, and the organization for that exposure. The same bodily injury exclusion example could apply if you're in the healthcare space, and you really need to look to purchase a med-mal policy. And so just keep that in mind. If we start with the broad wording within the policy, the commitment to you that the policy is going to protect you if named in the capacity as a director, officer, or employee, and then we look to the exclusions, start with the standard exclusions. Your broker consultant should be able to explain to you which are standard, and you'll find that you'll say, yeah, I do buy that products liability policy. I do buy that med-mal policy. Oh, yeah, I do have a monoline employment practices liability policy. But then we get into item 4, where this is where the battles typically exist with the underwriting community. You know, the underwriters, just to bring you all over the wall, many of them are trained to see the glass half empty. They need to understand what could go wrong and what could lead to a claim. And so many of them look at your sector, and you will see exclusions added to your policy in the form of an endorsement, stripping away coverage value. And so our first case study had to do with a technology company that received a patent infringement intellectual property claim. And because individuals were named in that case study, well, the policy responded. Well, you're seeing some underwriters adding an exclusion, a broad-based exclusion, for patent infringement intellectual property if you're a tech company in Northern California, because they know those claims are real. They've paid out on them. They see the trend. That's battleground in our view. You're going to fight the underwriter, you're going to market the account, and you're going to find an underwriter that is willing to give you a clean policy without that restriction. And it's your broker consultant's job to explain the differences. You may pay a little extra premium for it, but you need to understand what you're buying. So, you know, exclusions focused on exposures representative of your sector. Technology, you have biotech, pharma, bodily injury exclusions that are broad-based. Healthcare, where you're actually treating patients, you'll have med-mal, broad-based med-mal exclusions, maybe molestation exclusions. They're unorthodox. They pop off the page to a broker that does this every day, and it's worthy of a dialogue with you, the purchaser of this coverage. And again, sometimes if you have 3 quote options from 3 different insurance companies, this is a good way to determine which option to go with, the best path forward. And then finally, overly broad exclusions would be exclusions where, you know, when you think about the D&O policy, as we said over and over, it's broader in coverage scope for the individuals versus the company. And as Larry stated, that traditionally has been the case going back to the 1930s when the first D&O policies came into play. Overly broad exclusions are exclusions that not only pertain to the organization, but they also pertain to the individuals. And now you've got to really challenge the underwriter. You've got to question why you have that overly broad exclusion added to your policy. We won't get into further detail on that, but there's key legal wording underwriters will actually add to make exclusion very broad, exclusions that might kick out an indirect loss. And actually, I will give you one quick example of an overly broad exclusion. An overly broad exclusion that we will sometimes see is maybe an absolute exclusion pertaining to bodily injury. And so if you're a biotech company, let's use that as an example, and you have a bodily injury claim come in. At first, you think nothing of it. Okay, we're going to report this to our products liability policy. You do. Well, that blows up on you, and you get to a point where that bodily injury claim is doing real financial harm and financial damages to your organization, so much so that you've blown through your products liability limit of liability, and you find yourself now headed towards bankruptcy. Now, the claim in bankruptcy from your creditor, the D&O claim, is the indirect loss. It's the snowball effect. You started with a products liability claim that snowballed into a creditor claim that should hit a D&O policy. But because you have an absolute overly broad exclusion pertaining to bodily injury, the last thing you want to happen is your D&O insurance carrier to link that bankruptcy claim to the original products liability claim, which they see as the genesis of the issue. So watch out for overly broad exclusions. And again, what we're getting at here, have a healthy dialogue with your broker consultant, understand how these policies work, and dust that policy off, read the insuring agreement, read how you're protected, and then we recommend going to the exclusions to see if coverage value is being stripped away. So we're going to transition. I'm going to hand it back to Larry to go over some key takeaways. Larry?
Thanks, Adrian. So just to acknowledge, I know there's a couple folks who have submitted some questions online. Obviously, we're running a little bit short on time. We will go ahead and reach out to you personally. I don't want to ignore you, but we will follow up afterwards here to address those questions. So I just want to wrap up with a few key takeaways. If you're going to pick a time to wake up and remember the rest of the presentation, take a quick screen capture, now's the time. Number one, private, family-run companies, not just public ones, face many D&O risks. We talked about many of those. Not just shareholder risks. There's a whole bunch of other scenarios we went through. D&O coverage protects your company and your personal assets. In-demand talent expects the D&O coverage as a benefit. You may have directors demanding to see your D&O policies, what's your limits, what's the coverage looks like before they come on board. You know, that it can be a key recruiting benefit in many cases. And then finally, as Adrian just walked through, not all D&O policies are created equal. There's no off-the-shelf product that's going to work for every company. Make sure you talk with your D&O broker, understand your policy, know what exclusions and what other must-haves to ask for. So with that wraps up our webinar, Busting D&O Liability Myths. Thank you for your time, your participation. We really appreciate it. We hope you found it helpful, informative, and hopefully we didn't scare you too much. As we mentioned at the beginning, we encourage you to download the Broker Insight Report from the resource toolbox at the bottom of your screen there. It goes into more detail than we've been able to here today. Also, there's going to be a dialog box that pops up. If you would like a Hub D&O broker to reach out to you, feel free to enter your email address, contact information there right now. We're happy to follow up. And again, or reach out to your local Hub contact. If you have any direct questions or want to follow up on anything, get in touch. We'd be happy to answer your questions, assess your current policy, and determine your particular needs. So thanks again for your time, and we look forward to speaking to you again sometime soon.